Are we not? Thank you, Janet. Good morning, everyone, and thank you for joining us today for our annual roadshow, which is also a big milestone for the business, which is the 10-year anniversary since Invequity's establishment. So before I go into the heart of what I'm talking to you about today, which is flipping the script on BE, let me see, let me get my clicker. There we go. I thought just a quick reminder on who is Invequity and how it does business, right? So we've been in operation since 2016. We are a majority Black owned and majority Black female owned investment manager that is licensed and FSCA regulated. We are a specialist private equity fund manager. We manage over 50 private equity funds, combination of both bespoke, which means there's only one single investor, one LP in there, as well as the commingled. We are sitting at just shy of 1.8 billion of assets under management. And we're doing all of this with only 14 staff members. So I think that's quite impressive. But with that 14 staff count comes a vast amount of industry relevant experience and investment management experience. And in essence, how do we do what we do? We invest the capital that we receive from our clients, our investors, into revenue generating, high growth businesses that demonstrate that right nexus between capital returns as well as socio-economic and environmental returns. And with that, we have priority sectors that we ideally like to focus on because they represent that nexus. So that's just a reminder in case anyone here wasn't quite sure. But what am I talking about when we talk about flipping the script? So let's start off with the old script. So there's a phrase that I suspect many of you would have heard about 100 times in a boardroom that will have been uttered either by a compliance officer, a CFO, corporate affairs manager, and that phrase is uttered with the tone of apology, frustration, and perhaps even resignation. And that phrase is, oh, we need to sort out our BEE, as if it's some kind of a leak in the roof, a cost, a headache, something to be dealt with, managed, and then hopefully forgotten about until the next BEE scorecard audit the next year. So that's the old script. And we believe it's time to flip it. So for 20 years, under this old script, BEE has often been treated as a grudge purchase. So a compliance line item, a fronting risk to manage in certain cases, a discount corporates must pay to play and do business in South Africa. Under that script, Black ownership becomes a number on a certificate rather than a stake in the future. BEE deals get structured to hit that minimum percentage shareholding target, but not to build anything. And often when they're structured in that way through some kind of a vendor finance structure, when that vendor finance is hopefully repaid, that BEE partner walks off with very little in terms of a fundamental change from their own sort of balance sheet and real economic participation. And the corporate itself also feels like they were in some way shortchanged. So this is not a technical failure in BE. The codes were never really the problem. It's really more of a mindset failure. And it's the mindset that we believe needs to change. So what is the flip? So we asked the question, what if Black economic participation wasn't the cost of doing business in South Africa, but rather the engine of it? At Invequity, we structure these private equity vehicles to solve the ownership component of the scorecard, yes, but in a proper, defensible, fully code compliant manner. But that outcome is just the floor, not the ceiling of the desired target. The real thesis is a well-structured BE fund that should generate 2 simultaneous compounding returns. What do we mean by that? So, for the corporate client or investor, injecting capital into that BEE fund, the structure should achieve for them a genuine financial return that is market-related, risk-adjusted, and yet properly risk-managed, with real economic substance behind it, not just some kind of a paper structure where, in certain instances, a commission review could unwind it in a couple of years, but real ownership, real risk participation, and real yield. On the other side, for the investee company, that qualifying investee company, that small to medium enterprise that is at least 25% black owned, it's not just a change in their shareholder registry. It's catalytic growth capital, often the first real institutional-like balance sheet event for that business. It's potential access to new markets and procurement chains, and it's a founder who, over the next 5 to 10 years, is going to be in a position to build a business that is going to be fundamentally worth far more than what they began with. So, there you are, achieving your 2 returns, 1 instrument. Economic value for the corporate that is investing in the fund structure, and real economic and social value for the portfolio company. So, all sounds lovely. Where's the evidence? Okay. So, that evidence, multiple-fold. Firstly, our fund structure. It's not us asking you to take our word for the fact that the structures work. These structures have been designed and tested. They've stood up to the scrutiny of multiple top BEE verification agencies in our country, which means they are sound. These independently verified, true black ownership structures have done also real work in the market. Our clients have gone on to secure competitive tenders, both and additional customer contracts, both in the state and the private sector, directly off the back of their enhanced BEE ownership credentials. That's real revenue and earnings through the door for our clients. So, as just a sample of that, if we look at our bespoke funds, over the past 7 years, looking at from 2017, we find that on average, those businesses have generated EBITDA CAGRs of between 19 to 20%. And we believe that is not just correlation, but causation from being in that more enhanced empowerment position. Now, when we look at it on the other side in terms of the portfolio returns, across the portfolio, we have also achieved IRRs in excess of 11.7%, which again, that investment return, the portfolio, the corporate client is getting to see. So, there's the evidence. How? How are we doing this? So, it starts off with the tried and tested private equity structure that I've already alluded to, that is also supported by independent legal opinions. It continues with Invequity as a regulated FSC licensed investment advisor that is out there sourcing high quality investment opportunities on behalf of the funds it manage, and then going and injecting equity and quasi-equity instruments into businesses where we've done the hard work to understand them in depth and ensure their full alignment with our investment thesis, our investment criteria. It then continues with the discipline post-investing, where we go into those portfolio companies and look to enhance both the financial and the corporate governance, so that the growth is not just funded, but properly managed. Then, from a governance perspective, we also ensure that at that fund level, there is robust corporate governance there that ensures continued compliance with the codes, not just at the signature date, but for the duration of those structures. We also go further and track the sustainability and ESG metrics in the portfolio companies. Why do we do this? Because we recognize that good governance and sustainability are a lead indicator for the right financial performance. It's not a nice to do, there's a strong correlation. And so that just captures the three pillars that I've alluded to. The benefit of having a properly regulated investment advisor at the helm that is applying the governance both at the portfolio level as well as at the fund level, and then understanding the importance of integrating sustainability and ESG into that mix. So, my suggestion at this point is that the ask needs to look different. So whether you're a corporate looking at your BE scorecard, or an investor just looking for yield, or an advisor advising a corporate that's trying to figure out how to structure their BE deal. Stop asking, what is the minimum this deal needs to be to satisfy the codes? But rather, start asking, how do we structure something that is going to unlock real, sustainable value for both sides of the players of that equation over the next 5 to 10 years? Thank you. Before I hand over, I thought let me just bring your attention to the latest fund that we've launched and that we're excited about, which is the Solaris Private Equity Fund. It's designed to be that bridge between the corporate client who's looking to solve in a sustainable way for their BE ownership but get those returns that we've been talking about, as well as allowing institutional capital to come alongside so that the fund has the potential to be significantly scalable and be able to unlock larger scale transactions, create liquidity within that fund structure, and overall reduce the risk, the investment risk, because of the more diversified nature of what would be in that portfolio. So we're very excited to be inviting corporate clients and investors into this newly launched Solaris Fund. And that's it from me.